Overview of the Sultanate of Oman's VAT rules and VAT legislation, brought to you by VATCentric Limited. To introduce myself, my name is Tanwir Sheikh, a director of VATCentric Limited. I'm an industry expert in VAT who started off his career in London advising businesses around VAT-related matters. We've also got extended experience in the GCC helping businesses implement VAT and with their VAT compliance. With our extended knowledge of European VAT and GCC VAT, we're in an ideal place to help you and your business understand all things VAT related in the GCC market space. Join us on this journey to understand the basic principles of VAT that shall apply in the Sultanate of Oman. This is an introductory course, but there shall be later future advanced courses for business individuals, VAT practitioners, and budding students. Introduction to the VAT law in Oman. Oman is the fourth of the GCC member states to introduce VAT in the region. Of course, the first countries were the KSA as well as the United Arab Emirates, followed by Bahrain in 2019. Within Oman, it's been 12 years in the making. It was expected to be released earlier. However, Oman took the view of watching the other three countries first implement VAT, learn the lessons, and then introduce VAT and implement it by 2021. Oman has released its VAT law on the 18th of October 2020, which is a pivotal moment as this now declared and made it known that VAT was in fact going to come in the region 6 months after this date. Therefore, Oman will be implementing its VAT on the 16th of April 2021 as per the VAT law. The Oman VAT legislation is all derived from what's called the GCC VAT framework. In other words, the basis of the domestic VAT law in Oman is the GCC VAT framework, which was a set of principles and fundamentals which have all been agreed by the various different GCC member states. The VAT law cannot go against these principles that were agreed in the GCC VAT framework. However, many things were left open that allow the various domestic legislation to expand on and implement according to its own choices. And that's exactly what the Omani VAT law goes ahead and clarifies. It's important to also note that the 16th of April 2021 lands on a Friday, which traditionally means businesses are closed on this date, and therefore they should be ready for business with VAT the next working day. Another key date to note, and as mentioned in the VAT law, is of the executive regulations being introduced and implemented by the 13th of October 2021. And so why is this important? This comes 6 days after when VAT is effective in the region. This executive regulation is basically an expansion, a bolt-on of the VAT law. Many things need and are required to be expanded and can only be done via the executive regulations. Don't be surprised if the executive regulations take many different versions of itself. It is constantly updated by tax authorities because it is the first feature that can change before going back to the law. So those things which the law has left open, the executive regulations shall expand on, and if need be, can be updated as and when the tax authorities deem necessary. So therefore the 13th of October 2021 is by when the VAT law has stated that the executive regulations must be released by. Therefore you can expect many businesses, accountants and VAT practitioners to keep a keen eye on this date in order to fully understand how VAT is going to be implemented within Oman. So why is VAT important? And why do businesses need to take close note of VAT? First of all, it should be understood that VAT will have a huge commercial impact on the economy of Oman. It would lead to inflation of prices. This is because VAT will be a surcharge on the existing goods and services and directly absorbed by the end consumers. It will touch nearly all sectors within the economy: the oil and gas, financial services, consumer businesses and real estate, just to name a few. Politically, it should have a huge impact as well. And on policymakers, VAT is a form of taxation, and for a region that has not traditionally implemented tax, you can expect there to be many grumblings from society and various bodies who are not used to it or find it a bit alien. The main reason why VAT has been introduced, and has been introduced by many other countries across the OECD world, is because it is a key source of income for the government. Tax revenues can contribute a huge significant amount for various governments across the world, and Oman is no different. It is a form of diversification from its hydrocarbon and oil industry, a source of revenue, stable revenue for the government. We also expect to have its reputation propelled on the world stage and have recognition for being an advanced economy, advanced region which has implemented VAT, a form of taxation, just like many of the other large economies across the world. As mentioned, VAT will touch on every single sector within the economy of Oman. Different sectors will, though, feel the effects of VAT differently, and this is all down to the VAT law and VAT legislation within Oman. The different rates, the different reliefs are all stipulated in the law, and therefore will have different impacts on the different sectors. Various sectors have to be quite careful, especially if there's VAT leakages. In other words, where VAT has been blocked or absorbed within the VAT chain and therefore will pass on to the end consumer. In international dealings as well, VAT could have a huge impact, especially when trading overseas or even receiving goods or services from overseas. VAT has now got to be considered other taxes such as excise taxes or customs duty. Therefore, the tax space has become even more challenging for businesses. Hugely important should also be customs zones and free zones, as they can have a significant impact on VAT transactions, advantage of the various reliefs and exemptions given within the VAT law. There are two key thresholds that must be noted by businesses within Oman. The first one is the mandatory VAT registration threshold, which has currently been set at 38,500 Omani riyals, or 100,000 US dollars. What this basically means is that if a business is making sales which exceed 38,500 Omani riyals, then it must register for VAT. Now, there are two ways of looking at this. The business can look at its annual revenues, looking forward at the next 12 months, or even looking back at the last 12 months. If it has reached this amount or expects to reach 38,500, then it should register for VAT. On the other side is the voluntary VAT registration threshold, which is set at half of the mandatory registration threshold at 19,250 Omani riyals, or in other words, 50,000 US dollars. Again, if a business reaches this amount or can satisfy the authorities either on a historical basis or going forward basis, looking at 12 months worth of sales or supplies, that it can reach this amount between 19,250 to 38,500 riyals, then it can register for VAT on a voluntary basis. And the other benefit, or what's made it easier to reach this amount, is that the business not only can include its output supplies, in other words, its sales, which are taxable, but can also include what's called reverse charge supplies, those supplies which are received from overseas and are taxable within Oman, and the business has to self-account for VAT on those transactions. So it can combine both, and as long as it satisfies that it reaches within 19,250 to 38,500 within a 12-month space, then it can register on a voluntary basis. Some may ask, why would you want to voluntarily register? Well, there are huge benefits to that, both from a cash flow perspective as well as reputational perspective, why a business may want to. For overseas businesses, there's a slight different complication and complexity involved. There is no threshold which has been suggested for overseas businesses making supplies, taxable supplies into Oman. Therefore, if a business overseas is making taxable supplies into Oman and tax is due on those transactions, then it must register for VAT immediately. Can, though, appoint a tax representative to act on its behalf. However, there's some other complication involved with this, which has to be discussed in future. We can also note that there is something within the VAT law which is called VAT groups. It allows for VAT groups to operate, which basically means various corporate bodies which have common ownership can come together and create a bubble, a group, in which they all share one VAT registration threshold. They all share just one VAT registration as well and a VAT number. The benefit of this is all supplies within the VAT group are tax-free, there's no VAT due on them, and they also only need to file one VAT return. But all the members of the VAT group shall be jointly liable for any penalties or any liabilities with the tax authorities. So it's something to, again, consider before doing so. Businesses that make only zero-rated supplies within the Omani jurisdiction can be exempted from registering for VAT. But then the question they need to ask themselves is, how much VAT will they be forfeiting on the input tax or the expenses side of things? In neither of these cases can exempt supplies be included within the annual supply tests, as exempt supplies are not considered to be taxable transactions. So let us now look at the various VAT rates that shall be in operation within Oman. These VAT rates that have been set, which are within the scope of VAT, are all in line with the framework, the GCC VAT framework that has been agreed by the different member states. The default standard rate of VAT has been set at a minimum of 5%, and this 5% is what the introductory rate has been for all the various different member states that have implemented VAT so far. It is only the KSA that has decided to increase its standard rate to 15% after the pandemic hit in 2020. Oman, however, will opt for the standard rate of 5%, and this will hit vast swathes of sectors within the economy. So by default, any transactions within Oman shall take 5% standard rate VAT application within those transactions, unless stated for otherwise within the domestic VAT legislation or expanded in within the executive regulations. So take for example the mobile phone industry. The sale of mobile phones shall attract 5% VAT. Accountancy services shall also attract 5% VAT. Petrol, fuel shall also attract 5% VAT, as well as catering services such as restaurants will also have 5% VAT added on the final bills. Those supplies which are exempt from VAT are such as certain healthcare services. Again, VAT shall not be applied on those services. Financial services, local transport services, and some parts of educational services. These will all be exempt from VAT, which means VAT shall not be charged on those transactions. And another form of VAT liability is what's called the zero rating of VAT, or zero rated VAT. Again, this is charged at 0% VAT, just like exempt, and this shall impact the oil industry, certain medicine or medical supplies, food items, the gold industry, as well as exports. This shall all attract 0% VAT. However, what's important to note, the key differentiation factor between the exempt and zero-rated transactions are that VAT cannot be recovered on the input or expenses side of things which are associated with exempt supplies. VAT will be blocked. VAT shall be restricted when it's associated or attributable towards exempt supplies. Again, this is further expanded on in later slides. So therefore, zero-rated supplies and exempt supplies both don't attract VAT. However, both have different treatments when it comes to the treatment or the recovery of VAT. Now, those things which are outside the scope of VAT, that have nothing to do with VAT in terms of its liabilities, are things such as salaries or bonuses paid to employees, depreciation within the books, statutory fees, donations made by businesses or people, transfer of businesses when there's a sale, or insurance claims, or, as mentioned before, supplies made within VAT groups. These are all disregarded for VAT purposes. They do not fall within the scope of VAT, and the VAT law is silent on those such transactions. Another important or noteworthy thing to mention is the real estate sector. This is traditionally a sector with a lot of complications and can attract both standard rated VAT as well as exempt VAT on transactions depending on the nature of the real estate that has been dealt with. To put it simply, if you're dealing with commercial supplies, then usually the VAT at 5% standard rate is attracted. And when you're dealing with residential, non-commercial supplies of real estate, then this will usually fall within the bracket of exempt supplies. Input tax or input VAT. This is VAT which is incurred on purchases by businesses. For VAT registered businesses, or even businesses which are not registered, VAT on its expense base can be a huge and detrimental effect on its cash flow. However, making VAT as efficient as possible within its VAT supply chain is crucial. In order to mitigate VAT, a VAT registered business must ensure that it is claiming VAT at every stage possible and also complying with the relevant laws. Claiming back VAT is possible for businesses that are registered for VAT only. It can claim back up to 3 years. Any VAT that has been incurred can be claimed by the business from the end of the tax period that it has been claimed by. However, businesses must also note that certain VAT on its cost base or input tax cannot be claimed for various reasons. These can stem from reasons to do with such as being related to exempt supplies. So if a business is making exempt financial service supplies, for example, any VAT which has been incurred in making those supplies, either goods or services, which are associated or attributable towards those exempt supplies by the business cannot be recovered. It is going to be blocked and therefore absorbed by the business. This also applies to illegal goods, those things which are services prohibited within Oman. They cannot be recovered by the businesses. Also, those goods which are being imported into Oman, which are exempt, any services or goods which are relating to that supply incurred by that business cannot be recovered. This also comes into what's called partial exemption, another piece within the VAT legislation where certain VAT cannot be recovered even on a percentage basis. And the details of this shall be expanded for in the executive regulations. So to put it simply, businesses want to recover VAT as much as possible to help with their cash flow and improve their VAT flow, then penalties can be applied on the business. This is also very important for capital assets, large purchases that are made by the business which will be capitalized in its books, as VAT recovery on those items will fall under a different method of VAT recovery. This again must be noted by businesses, as if they are in the business of making some exempt supplies, the VAT recovery is not as straightforward, and they must be aware of the various different methodologies and calculations required to get the VAT recovery absolutely correct. So businesses want to recover VAT as much as possible and pass it through. Remember, the design of VAT is such that the end consumer is the one who absorbs VAT. VAT-registered businesses should be able to pass it through their supply chains. The Omani VAT law does also state that where VAT has been incurred in relation to commercial samples or certain gifts, or even where goods have been destroyed or stolen, VAT can still be recovered in respect of those supplies, which is quite a liberal approach and good for businesses. Within the business of their supply chain, they want to decrease VAT leakages or VAT blockage within their supply chain. Where possible, they need to also ensure that they are complying with the relevant laws, because if they do not, compliance. VAT compliance can be divided into two sections. Those are the record requirements and also the VAT returns. The record requirements are in relation to the tax documents that are raised, the tax documents that are created which record the VAT due on transactions. The legislation tells us what these compliance requirements are. It also expands and tells us what and when a VAT invoice shall be raised under the time of supply rules. Essentially, the VAT that is created under transactions must be paid over and handed over to the tax authorities. They are collected by the various taxable businesses, taxable persons, and should be passed over and handed over to the tax authorities via the VAT return, although businesses can net off any purchases that they have incurred with VAT on it and then pay over the net balance. Keeping records is essential because this is the primary form of documentation or evidence of VAT incurred or VAT raised or created by businesses. This is dictated by tax invoices. The requirements of tax invoices comes under the compliance rules, and businesses must ensure that tax invoices are raised for each taxable supply. This should also be retained under what's been stipulated under the law. At the moment, any tax document that is raised must be retained and kept by a business up to 10 years. Therefore, that means the tax authority can request those documents at any time and look to view it or review those tax invoices as evidence of those taxable supplies. When it comes to real estate, this has been increased to 15 years. So for 15 years, businesses must keep those records and be able to produce it to the tax authorities should it be required. The tax invoice requirements are stipulated in the law, but it also allows certain sectors, such as the retail space, to produce what's called simplified tax invoices, which are shortened requirements or less requirements in terms of what a tax invoice must show. If these things are not kept in place or they are not adhered to, then very many penalties can be imposed on a business. It should also be noted that the legislation also allows for alternative evidence where VAT invoices or tax invoices are not created, such as when it comes to bank statements, etc., as evidence of VAT being incurred. This can also should be kept and can be produced to tax authorities, but only under certain circumstances, which again shall be expanded under within the tax regulations or the executive regulations. Where businesses are raising foreign tax invoices, they must ensure they are also converted into Omani Riyals using a relevant conversion method, which has been deemed acceptable by the Omani tax authorities. It should also be noted that the tax authorities can also force adjustments themselves should they deem it necessary. VAT returns. The VAT return is the primary form or submission method of notifying the tax authorities of how much VAT has been incurred by the business and how much has been charged by the business to its recipients. The VAT return shall detail or have all the details on there or what should be reported over to the tax authorities. In terms of the timing of VAT returns, this could be either on a monthly basis or quarterly. However, details of this shall only be produced when the executive regulations have been released. What we do know under the VAT law is that the return and payment of VAT after VAT period has ended shall be within 30 days. So for example, if a VAT period has ended on 30th of September 2021, then the VAT return and the payment associated with that VAT return must be made within 30 days. In other words, by the 31st of October 2021. Again, the details of this shall be released in the executive regulations. But what we do know is that the payment and the return must be made on the same day to the tax authorities. The adjustments by the tax authorities can also be done in the same time frame, and businesses can also make certain adjustments to tax returns in relation to previous returns submitted. When there is a fraud investigation with relation to the VAT returns, the time frame can be extended for any adjustments that are required. When it comes to refunds, in other words, payment from the tax authorities in respect of VAT, this has been allowed for within the legislation for example, tourists that are visiting the region and incur VAT on their purchases, such as in the shopping malls, or for example, non-resident businesses, those businesses that do not have an establishment within Oman, however, will be able to recover VAT under certain circumstances which can be dictated by certain treaties with the relevant country or domestic country that this non-resident business is resident to. Diplomats and certain organizational bodies may also have discretion to recover VAT or have VAT returned to them by the Omani tax authorities, again depending on treaties in place. So the law tells us that there is scope for these things, however the details of this shall only come through when the executive regulations are released. And again, this mirrors other member states within the region as well. Penalties. As the old saying says, where there are rules, rules are there to be broken. However, when it comes to tax law or tax compliance, the penalties can be quite severe and businesses must make note of these penalties and what can make business fall afoul of the tax rules. Therefore, it is essential to keep abreast of what the laws and the rules say and what the requirements are for businesses. When it comes to penalties, this can range from 3 different forms. It could be potentially a percentage-based penalty from the tax authority, or it could be a fixed penalty from the authority, or even imprisonment. This all depends on the nature of the error or where the miscompliance has occurred. The simplest of the errors or miscompliance will be in relation to late filings of the VAT return. So should it be late, a percentage-based penalty will be imposed on a business, particularly if it's a repeat offence. Other things will then be in the categories of errors or where payment has not been made to the tax authority or where the compliance rules have not been followed correctly by the businesses, such as not raising correct invoices or charging VAT on certain transactions. This is where a business can start entering into the realm of fixed penalties ranging from 1,000 Omani Riyals to 10,000 Omani Riyals. And also, again, depending on the severity of the error or severity of the fraud, this can even lead to imprisonment for various stakeholders who have been involved in the VAT return processes. Of course, if it is found that a business has deliberately looked to defraud the tax authorities, then huge penalties can be at stake. Therefore, the rule is do not try to deceive the tax authorities, pay the right tax, file the right returns, and do not try to conceal errors, and be as open as transparent to the tax authorities as possible to avoid the harshest penalties at stake. It should also be noted that where penalties have been imposed on businesses by the tax authorities, there is a mechanism in order to appeal those and go for tax dispute resolutions. The details of this have been specified within the Omani VAT legislation, and again, the details of this shall be further expanded for in the executive regulations. However, we do know that these cases can be taken to the courts if a business feels that the tax authorities have wrongly imposed a penalty on a business and that it did not act incorrectly. Date of supply, or time of supply for VAT purposes. It is essential to know when the date of supply has crystallized in order to be able to record VAT correctly onto the relevant VAT return period. It also lets a business know when it can recover VAT on a relevant supply. This all revolves around VAT accounting. The VAT legislation in Oman gives us simple rules of how to determine when this time of supply has actually crystallized in relation to a VAT transaction. The way to do it is to look at when actually the good or service was delivered or provided, then to look at the date of the invoice, and then also look at the date of payment in relation to that transaction. You simply need to take the earliest date of either of those events. Earliest of those events shall be the date of supply, or the time of supply for VAT purposes, and is the date you should go by when it comes to your VAT reporting. When it comes to continuous supplies, those supplies with multiple deliveries or services provided over various periods of time and a certain contract, the time of supply will be determined by the actual payment made or the payment dates on the invoices that are raised. So continuous supplies have usually several invoices that are raised periodically, and therefore when payment is actually made for those continuous supplies, we will go by the earliest date of actual payment or the actual date as stated on the invoices. It is also worth mentioning about two other types of transactions where the date of supply or time of supply rules are slightly different. These are in relation to imports. In relation to imports, you simply look at the date of import or the date of entry at the first port of entry in Oman or the date of release from suspension in any sort of custom warehouse. The earliest date of these events shall be the time of supply for VAT purposes. And lastly, the other complication relates to prepaid calling cards or vouchers. There's different types of vouchers out there in the market, such as single-use vouchers or multiple-use vouchers. And in order to determine the time of supply in relation to these vouchers or prepaid calling cards, the executive regulations need to be awaited where further expansion shall be made.
In this slide, we discuss the place of supply rules. The place of supply rules are important in order to determine whether Oman VAT rules shall apply to a transaction or not. The first thing we need to determine is whether we're dealing with goods or services. The basic rule with goods is that the place of supply shall be determined by where the location of the goods are when the supply began. For example, if the goods were made available to the customer to collect, and this was in Oman, then the place of supply shall be in Oman. And likewise, if the supplier was arranging the transportation and the goods were located in Oman at the time of dispatch, then the place of supply shall be in Oman as well. However, it should be noted that if we are dealing with intra-GCC supplies, whereby the supplier or the customer is based in another GCC member state, then the rules will be slightly complex and shall be further expanded in the executive regulations. The place of supply for a service is dictated by where the supplier has their place of residence. And if the supplier is a taxable business registered in Oman, then place of supply shall be in Oman. Again, the rules get slightly complicated if we're dealing with overseas transactions. And also, it should be noted that Omani VAT shall never be due if the place of supply is not in Oman. There are also other exceptions to the basic rules, such as if we are dealing with oil, gas and water through a pipeline or electricity supplies, which comes under goods. The rules are slightly complex around these and shall be further expanded in the executive regulations. Likewise, other specific rules relate to services as well, such as if we are dealing with real estate, then we shall look at where the land is located in order to determine the place of supply. When it comes to transportation, it is important to know where the journey began to know where the place of supply is. For restaurants, hotels, entertainment, and sports events, the place of supply is based on where the services were performed. And for telecommunication, e-media and broadcasting, it is where the actual use or benefit was taken by the customer that shall determine whether the place of supply is. So if the use or the benefit was in the Sultan of Oman, then Omani VAT shall be due, place of supply is in Oman. When it comes to cross-border transactions, in other words, the goods are received or their services from overseas, then the rules are slightly more complicated and the executive regulations need to be further studied in detail to know where the place of supply is. Because as mentioned before, the place of supply is determining whether Omani VAT is due on a transaction or not and shall impact the VAT reporting. And the VAT practitioner shall also need to look at whether the businesses are registered for VAT in Oman or in any other GCC member state, as this can also determine where the place of supply is. Generally, for non-registered VAT businesses who are not registered in Oman and are based in overseas, then this shall be out of the scope of Omani VAT. So to recap, if the supply is registered for VAT in Oman, but the customer is not a taxable person, in other words, he's not registered in Oman or registered in any other GCC member state, then the place of supply shall still be in Oman. However, where the supplier is registered for VAT in Oman, but the customer is registered for VAT either in another GCC member state or is registered in Oman for VAT, the place of supply shall be determined by where the customer is located and in any case could be either in the other GCC member state or in Oman. So the place of supply shall be determined by the customer's residence.
VAT flow of a transaction in Oman. So let us see now how VAT flows through a typical transaction that will take place in Oman once VAT is introduced. Here we have a manufacturer that sells and manufactures sandals. It sells this to a retailer named Souk Limited. Souk Limited then of course goes on to sell this to an end consumer. The manufacturer manufactures the good, which is the sandals, and prices this at 50 Omani Riyals. When it sells this to the retailer Souk Limited, it charges 50 Omani Riyals, but also must charge VAT at 5%. Therefore, there's an additional tax at 2.5 Omani Riyals that it must charge on to Souk Limited. The total price therefore paid is 52.5 Omani Riyals by Souk Limited. The 2.5 Omani Riyals collected by the manufacturer will be paid over to the tax authority. Souk Limited then goes on to sell this to a consumer or an end customer. Souk Limited of course wants to make profit on the purchases made from the manufacturer and therefore prices the sandals at 60 Omani Riyals, which is the net price. However, when it is selling it on to the customer, it must also charge VAT at the standard 5% rate. Therefore, 3 Omani Riyals is charged in addition to the 60 Omani Riyals it has set as the price. 63 Omani Riyals is therefore paid by the end customer, which is inclusive of VAT. So the gross price was 63 Omani Riyals. Souk Limited has therefore collected 3 Omani Riyals from its customer and paid over 2.5 Omani Riyals when it bought it from the manufacturer. From the tax authority's perspective, it has received 3 Omani Riyals. 0.5 Omani Riyals is what Souk Limited has paid over, which was 3 Omani Riyals it has charged its customer and 2.5 Omani Riyals that it paid over, which it can reclaim. The 3 minus the 2.5 Omani Riyals gives it a net payment of 0.5. Therefore, Souk Limited will pay over 0.5 Omani Riyals to the tax authority via its VAT return. The manufacturer, assuming it doesn't make any reclaims, will pay over 2.5 Omani Riyals, which was the output tax it charged Souk Limited. The tax authority therefore has collected 3 Omani Riyals in total. As you can see, the end customer is the one who bears the cost of the VAT. It has paid 3 Omani Riyals and has no mechanism of recovering this. Therefore, the end customer is the one who bears the total cost from the VAT, and the VAT flows through the whole chain via the different taxable parties. Transitional provisions. The transitional provisions have been a key feature of the VAT law and executive regulations in all the key member states when they have implemented VAT. The reason why it's so important is because it tells us what and how to treat VAT when it expands or when it crosses over onto the VAT implementation date. Here, the key date is 16th of April 2021. So where certain contracts or transactions have been pre-agreed to the VAT implementation date, it is key to know how much or if VAT is actually due on that transaction. The complications arise where these contracts have been pre-agreed, but will span across both pre-VAT and post-VAT go-live. how much and when shall VAT be due on those transactions, and is there a way of mitigating it without breaching any of the laws? The law in the Omani VAT legislation has said that where a contract has been made or pre-agreed already and is silent on VAT, and it is later found that VAT is actually due on the transaction, and there is no mention of VAT in the contract, then the consideration shall be deemed to be VAT inclusive. That is to say that VAT is embedded into the price and shall not be charged on further to the customer. The main aspect of this is that the tax authority will expect VAT to be accounted for and it must be paid over to them. And usually it is the supplier's responsibility to ensure that VAT is gone over, and they may have to absorb the cost with regards to VAT and pay it out of the price or the consideration received from the recipient. Therefore, it is essential for businesses to ensure, is VAT due on the transaction? Would it trespass the 16th of April 2021? And who shall pay that VAT which shall be due? Where certain supplies come under the remit of continuous supplies and span both pre-VAT go live and post-VAT go live, then the transaction may be split into two parts, whereby a portion of the transaction which relates to pre-VAT go live shall be deemed not taxable, and those parts of the transaction which are deemed post-VAT go live shall be liable to VAT. Again, this shall all be expanded for with details and examples in the executive regulations. However, again, businesses should be mindful of this. However, in spite of the VAT legislation now being released and details of the VAT law made public, if a transaction has been fully completed and paid for prior to 16th of April 2021, then no VAT shall be due on that transaction. It is only for those transactions with a time of supply which either span into VAT go live or after VAT go live, then VAT should be taken into consideration. Here we presented simple examples of certain transactions that can take place. Here at first we have goods which have been supplied prior to the 16th of April 2021. The goods have been delivered and supplied to the customer, and whether the payment has been made after or before the 16th of April 2021, or whether the invoice has been raised prior to 16th of April or after 16th of April 2021, no VAT shall be due on this transaction because the goods have been supplied and delivered prior to pre-VAT go live. However, if the goods were supplied after VAT go live on the 16th of April 2021, then VAT shall be due on the transaction. When it comes to services, it's slightly more complex because we have to see to what extent has a service been completed. If the service was completed fully prior to VAT go live on the 16th of April 2021, again, irregardless of when payment has been made or when the VAT invoice has been raised, no VAT shall be due on this transaction because it was fully completed prior to VAT go live. However, if there was a service that was either taken place after VAT go live or took place which spanned into VAT go live, then this may be a state or a situation where the VAT has to be split depending on how much of the service was completed prior to VAT go live on the 16th of April 2021 and how much of the service was completed after VAT go live. And therefore you'll see a break of the fee, the break of the consideration, with some of it subject to VAT and some of it partially not subject to VAT. Of course, if the supply is zero rated or exempt from VAT, then these transitional provisions do not really make a huge difference except on the input tax recovery side for exempt transactions. Excise tax. Excise tax is another form of indirect tax which impacts the Sultanate of Oman. Excise tax was enacted in June 2019. It's a law that wants to tax a further additional tax on those products which are deemed harmful to society. These include things such as tobacco or pork products, alcohol drinks, as well as sweetened energy drinks and carbonated drinks. The rates of excise tax can range from 50% to 100%. 100% is the more common rate that is found now and applies to many of those products that are under the excise list. Anyone involved in the supply chain of excisable products must file a return and charge excise tax on those products. The way the excise tax is determined is based on the sale price. There is what's called a standard price and a retail sale price of the product. Whichever is a higher amount, then the tax must be applied on that amount. For example, if we had a standard price which was set by the manufacturer on a carbonated drink at 5 Omani Rial and the retail sale price was 6 Omani Rial, we will take the higher value of the retail sale price at 6 Omani Rial and apply 50% excise tax rate on this. Therefore, 3 Omani Rials will be applied as an excise tax rate on the sale of this carbonated drink. This is filed via a return which is submitted to the tax authorities. The tax authorities will expect returns from anyone dealing in excise taxes or anyone supplying excisable products. And these can include producers, importers of excise goods, or any person who releases an excise good for consumption into the market. Also, anyone holding excise goods for which the tax is due and has not been paid must also file the return and ensure that the tax has gone over to the tax authorities. The excise tax can be suspended if it's located in what's called a tax warehouse or transported between tax warehouses under a tax suspension scheme. Although excise tax is only due to be paid once, either usually at the manufacturing stage or at the time of import, it is essential to determine what the value is for the excise rate to be applied upon, and also to note that inflationary pressures will apply on such products. Of course, this is to discourage excessive consumption and excessive purchasing of such products. Thank you for joining us on this introductory course to VAT in the Sultan of Oman. For more information, please visit our website www.vat-centric.com or contact us on info@vat-centric.com.